So, let me share what I saw and what you saw, and we ended up sharing this.
Can you present it again? It dropped off. And then I'll bring it up. Yeah, this is probably one of the worst that I've seen in a while. All right, let me know when you're ready.
Yep, ready.
Yeah. Okay. Yeah. Can you zoom in? Here, I'm going to full screen this too. There we go. Okay. All right. What you got for us?
Okay. So this is the numerical page of the policy. You can see on the side. I thought it was funny because it was called the wealth accumulate. And then you look over here on the right-hand side. So by the way, this is assuming a 6.63% interest. By the way, this is a policy with Lincoln. And one of the issues with IUL is the fact that the insurance company has levers inside the policy, right, where they can lower the cap rates, they can increase the cost of insurance. And Matt, Lincoln is one I've had personal experience where they have lowered the cap rates, where you literally cannot succeed, right?
Yeah, that's really frustrating, man.
Yeah,
they don't usually lower them until after you have the policy. Like, one of our mentors, Chris Kirkpatrick, runs the Life 180. He calls it really a marketing expense, right? They promote the higher cap rates, and then as the policy matures, they lower those cap rates. Then they come out with a different product, a different type of IUL, and it basically just repeats the cycle over and over again. So yeah, you got to be really careful with that stuff, guys. They can change so many different things in the policy. You might start with a really nice, good-looking cap rate. Is it going to stay there? I don't know. Maybe it does for some companies. I don't think we're saying like every company does this, but it's definitely possible.
Yeah, for sure. So you look here, Matt. If you look at 10 years, I want you to think how this is a $500,000 death benefit. How much would it cost to get a $500,000 of coverage for a 41-year-old for 10 years?
A term policy for 10 years?
Yeah.
It's not going to be $4,000 a year.
It's probably going to
like a couple $100, a few $100 a year.
Probably like $100 a month, if that.
Yeah,
right.
Not $4,000 a year.
You're talking about, let's call it $1,000 to $1,200 a year, right? And look at this, right? After 10 years, this client has paid in $40,000. By the way, no access to a single dollar the first 8 years,
dude,
or 7 years.
That is crazy. I think that's the longest I've seen an IUL policy go without access to anything, access to cash value. That's nuts.
Yeah, and it's because it was set not at the target premium, but the minimum premium.
Can I ask you something about that really quick, Michael?
Yeah.
Is there any scenario that you can think of where a client would be describing what they're trying to accomplish and you would recommend a minimum funded policy? Is there any scenario you can think of?
No. I would say this. If the intention is to stay minimally funded, just buy the term. Right. Now, can you start a policy with a minimum fund with the intention of funding it later? You could do that. But yeah, it's just understanding that, again, all the problems with IUL come in large part because of the lens and the frames that you're looking at it through, right? You're looking at it as a permanent product, and the reality is it's a term product.
Right.
And so
even when, if you were to start with the minimum and then go up to the max fund later or whatever target, I don't think you're setting yourself up for success with that. Like, if you have to do that, you might not be ready to do something like this yet. Maybe buy a convertible term policy, convert it into a whole life policy later. We talk about that pretty frequently. But, if you have to minimum fund the policy, in my experience, it's my opinion, you're probably not ready to do this, right? You need to build a stronger foundation first.
Yeah. yeah, like I said, it's understanding that it's not a permanent policy, right?
Yeah.
And so
And it's crazy that it's promoted as one, man. That's just, man,
yeah,
it's so misleading.
but Matt, I mean, from 40,000 down to 12.9, this client is taking a $27,000 loss over 10 years.
That's so crazy, man.
That's
So-
huge. Think of the opportunity cost of that going forward, right?
Right.
Think of
100%. Dude. Like, it's just, that's
that
egregious, man.
this client right
That's
here
a
alone.
lost decade. They talk
Yeah.
about the lost decade from the great financial crash. This, or is it the .com bust? Whatever. Lost decade right here.
Yeah, I want you to see something else here, Matt. I want you to look at year one. Let's look at this. So you see the net annual outlay. It says $4,014,
Mm-hmm.
and then the net policy value is 309, right? Now, I want to point this out because you have to understand it's an annual renewable term,
Mm-hmm.
right? Meaning the costs in the policy are going up every single year.
Mm-hmm.
And if that weren't the case, then ideally, Matt, if you were to put in the same amount of dollars for the second year plus earn a 6% interest,
Mm-hmm.
wouldn't you have a little bit more than double the next year?
You would think.
You'd think, right? So you'd at least have the 309 for the next year plus the 6%
Right.
credit year, right? Which would, in this case, let's call it $18. 309 plus 309, 618 plus another 18. So you'd be at like 638,
Mm-hmm.
right? But look, you're actually less than double the next year.
Is that because of the cost of insurance?
That's because the cost of insurance went up.
So wild, man.
Yeah. And so that's what people...
that right there is an extremely expensive term policy right there.
Yeah.
Is the other issue too that this is an option A design, right? Level death benefit.
It is.
Right. The 500,000 stays the same. And I believe, correct me if I'm wrong, Michael, but you make more commission on an option A level death benefit than you do increasing. Is that correct?
It not necessarily, but yes, in this case, it was minimally funded. If you minimum fund any death, you're going to make a ton of commission.
Right.
And so,
can you, one of the things I wanted to ask you, just for clarification for somebody, for those that are watching this, have just been introduced to IUL, maybe they're considering a policy, they're looking at illustrations. What is the difference there between the net policy value and the surrender value?
Yeah, so there's a charge in the policy, right? And so if you're going to do IUL, you also need to remove that surrender charge. And by the way, your agent has the ability to remove that surrender charge, right? So if they don't do it,
means you would, if this agent had done that in year one, this client would have had access to cash value in that surrender value column, correct?
Correct. They would have had access to 309.
Right.
Yeah.
Now, why wouldn't an agent do that?
So, two things, right? Well, the reason the agent wouldn't do that, let's talk about two things that your agent, if you want to use IUL correctly, your agent has to do two things, but they won't, right? The first thing is they need to use a term rider or a term blend. What this does is it actually cuts a lot of the costs out of the policy because that's a non-commissionable term rider, right? So you can use a term rider for 75% of the coverage typically, right? Meaning if you had a $400,000 death benefit, your agent's getting paid as if he sold you a $100,000 death benefit.
Right.
Right. And we'll look at the commissions and you'll see how outrageous the commissions are on this policy. Hint, it's about $10,000. So for this, right? And so yeah, exactly. Right. And so the
only person accumulating wealth in this scenario is the agent.
Yep, and the insurance company.
And the insurance company.
But as you can see, definitely not the client, right? So number one, the agent needs to remove the commissions to give the policy even a chance to perform the way it was supposed to. It was intended to perform. And by the way, they won't do that because obviously it's a 75% cut in their commission.
Sure. You're taking food off their table at that point.
The second thing you need to do, your agent needs to do, is they need to remove the surrender charge, right? Think about what makes life insurance so powerful, Matt. It's the access to capital, right? It's the ability to leverage. And so if your agent isn't removing that surrender charge, you don't have access to this capital.
Right.
By the way, the surrender charge on this policy in year one is $15,000. Right.
That's insane, man.
And so in order for you to optimize a IUL, your agent has to remove the surrender charge. Now, the reason why agents won't remove the surrender charge is because a lot of times they're just trying to make a sale, right? They're trying to make a commission. When you remove the surrender charge, there's something called a chargeback. And what that means is in the first year, if you cancel this policy, the agent's going to get a chargeback. They're going to have to pay back all their commission that they received. Right. So the policy has to make it to month 13 in most cases. Now, when you take the surrender charge off, that liability for the agent goes to 5 years.
Really? Okay.
It does. And so that's why you're typically not going to find many agents that are willing to do that.
Is that pretty common across the board for most IUL companies or just IULs in general?
Yep, that is.
It adds
every
possibility of a chargeback for 5 years. We'll call it 3 to 5 years, whatever. Each company might be a little bit different.
Yes, because remember, if they cancel the policy now, they get all their money back. They don't right. lose. Because remember, that surrender charge is essentially guaranteeing the commission. Right. They're saying this is the cost of us issuing this policy.
Right.
And so if you cancel it beforehand, up to that dollar amount in cash value is ours.
Yeah.
And so that's
wild. That's so wild. And just like go back to my previous question, the net policy value versus the surrender value. So the surrender value column, guys, correct me if I'm wrong, Michael, that's the amount of cash value you have access to that you could take a policy loan against. Is that correct?
Correct.
Okay.
The surrender value you can loan against, or if you do cancel your policy, that's how much you get back.
That's how much you would get. Right. Okay. So the surrender value with what we're talking about, that access to capital and using it to build wealth, the surrender value is one of the most important columns here. So if you see a bunch of zeros, but you're putting in money each year, there's a big problem. Very, very big problem here.
Yeah, 100%. 100%. And we can break this down in the cost. So let's do that. So this is the cost of the policy, right? This is typically further down. Some illustrations don't even show you this. Right. You actually have to, as an agent, in a lot of cases, you have to add it to the illustration, this report. Yeah. Right.
Michael, are you able to zoom in on it just a little bit? Can you blow it up a little bit? Yeah, there we go. There we go. Okay, cool.
Yeah. So you look at year one, and this shows where all the money goes, right? So $482 goes to a premium load, right? So there's a minimum percentage of all your premiums that there's a premium load.
And that's pretty common for IUL policies, right?
Mm-hmm.
No need.
Here's the cost of insurance. You see $70. Like it's not a lot, right? Because it's an annual renewable term.
And he's 42, probably in good health, right?
Yeah, he got a preferred here. Yep. He is a tobacco user, but it's still a preferred tobacco. What you see is the big one here, and a lot of times you'll see this as the per thousand charge. You'll see this under different areas here, but $3,155, right? And this is a huge charge in the policy. Yeah. And so that's where all your money's going right here.
What benefit do you get from that? What is that charge for?
Well, that charge takes care of this down here. So let's really blow this up. Do you see that, Matt, down there? TP, $8,630.
Okay. Yep.
So that's the target premium on this policy. What that means is this agent is earning on $8,630. Now, typically this is a rolling as could be a 2-year rolling period. And that's why some of these agents will minimum fund, because it's kind of like double dipping. They can get paid for the first year commissions and the second year commissions at the same rate. But typically your agent is probably making between 120, 150% of this, right? So when you, even at 120%, you're talking about a $10,000 commission.
Right.
So where does that come from?
He got paid for $8,600 of premium, but the client's only putting in $4,000. What's the discrepancy there? Is that an example of the minimum funded, like minimum funding a policy?
Yeah. So minimum fund, and typically,
right? He could put 8,600 in per year if he wanted, right?
Yeah, he could actually put a little bit more than that. I think this one was almost 10,000.
Right.
But
they've set it up here where he's starting as $4,000 per year.
Right. And typically when you sell at a target, let's say it's a target premium or a target funded policy, you're, as the agent, you're going to earn, say, that 140% on the first year commission, right? After that, you might earn 2%. But by doing it this way, a lot of these companies, what they have is a 2-year rolling period for you to meet the target premium. So now, if this client's budget was only $4,000, he's not only getting paid on the first year $4,000. He is getting paid on the second year $4,000.
Yeah. Up front, right?
It depends. Some of these companies advance, some of them don't. So it could be pay as you go.
That's crazy. So then at year 8, it looks like that drops off, right? That it goes down pretty significantly. So why is there such a significant drop in those charges at year 8?
Yeah, so that's when they start
getting out of the period.
Yeah, so a lot of these companies. So I'll use a more common phrase, the per thousand charge. A lot of these companies will illustrate this charge maybe for 10 years. However, contractually guaranteed, they can charge it all years, right? And so what these companies do is they actually they have a current assumption of how long these charges will be on the policy. And what that does is it allows them to illustrate without those charges going forward. In like in years 11 through 20, you see the cost of this policy is a lot smaller, right? It allows them to illustrate that. But remember, contractually guaranteed, they could choose to charge that all the way through the policy all years.
Sure.
Right. And that's what a lot of these
lever they can pull.
It's a lever that they can pull. And so you don't actually know what you're going to get. It's one of the reasons why these policies, it's like a minefield, Matt. I tell people it's like a minefield. You really don't know unless you're really good on the inside. You familiar with these companies,
right?
And the reality is when you think about how many agents are, this is an industry where 92% of agents fail in their first year and they're out. So already that brings you down to about 8%, right? And then I would say I started learning this stuff about 4 to 5 years, about 4 years into my career. So you think about how many agents start to notice like, hey, these numbers aren't what I thought they were. Right.
Yeah, something's wrong here.
Something's going on. Yes. I need to learn more. And then, by the way, Matt, how many agents do you know that you make aware of that and they don't want to hear it?
Oh yeah. I get some pretty interesting comments on it. Lots of it turns into a personal attack. Like I'm coming after their character or something because I'm calling out this crappy product, you know? A lot of them don't take it very well.
And Matt, the reality is when you understand only 8% even make it past the first year, then you go 4 years out, right? It's even a smaller percentage. And then you have to cut out all the people that don't want to hear it, all the people that are just remain ignorant. You're talking about less than 1% of agents that actually know what they're doing.
That's so dangerous because there's probably hundreds of thousands now across the country selling this stuff, especially like the big MLM companies for financial services and stuff. And there's just so much of it out there. It's ridiculous.
Yeah.
So what is
this Matt is
elements?
This is the part of the illustration that they all skip over, right? Non-guaranteed elements. This policy contains non-guaranteed elements and index account non-guaranteed elements. NGEs include cost of insurance rate, policy value charge, administrative
which is what you were just talking about. Yep.
Administrative charges, premium load, interest rate credit to the fixed account, interest rate credit to the holding account, interest rate credit to the dollar cost averaging account, and the account value enhancement rider. See the index account section for the list of the index account NGEs applicable to each index account. Basically, what they're telling you right here, Matt, is every single piece of this policy is flexible.
Yep, it's basically up for renewal every year.
Yeah.
Do we want to keep it the same? Do we want to change it? Maybe sometimes in your favor, sometimes not. And here's the thing, guys, it's what they need to do in order to manage risk because of the option strategy involved with this indexing, with the indexing interest on an IUL. There's so many different elements involved. You have the cost of call options, you have the call option budget. You have your rising cost of insurance. There's so many things, so many levers that they need to be able to pull in order to manage risk, and that you suffer the consequences of that. The life insurance companies still do good. They still do really good, but anything in your policy can change. And like, if you were to go into business with somebody, you sign a contract and you're putting up all the risk, right? But your business partner has the right to change the contract. You can't change the contract, but your business partner can change the contract at any time in order to benefit your partner. Would you get into business with them signing a contract like that? I wouldn't. That doesn't make any sense to me. But you're seeing it right here. Okay. Right in this is part of the illustration, right, Michael? It's right in the illustration. Yep.
This is on page 4 of this illustration. I just didn't show the whole illustration because I didn't have the time to go through and take the client's name out. But
it's there. All these things can be changed.
Yeah. So if you look, by the way, Matt, look at the second paragraph and we'll end it as far as this goes here. But we may make changes to each of these NGEs and index account NGEs as described in the policy. Such changes can be made in consideration of one or more of the items listed in the policy. A change to one or more of these NGEs and index account NGEs can affect your policy's performance, including coverage duration and premiums required to keep your policy in force and surrender value. So they're right there. When you say including coverage duration, what does that tell you, Matt? It's not a permanent policy.
Not permanent. Yep. That's it's very dangerous, man. And I've seen so many stories of that where people thought it was a let me back out of here. Thought it was a permanent policy. Like these like the traditional universal life policies. People stopped making premium payments at one point, just thought it would always be there, and they'd be able to pass on this legacy to their loved ones. And all of a sudden, they're 90 years old, they get a bill for $12,000 because all their cash value is gone. And if you want to keep your policy in force, here's what you need to pay us. And it's a lot of the times it's too late to do anything with it by the time people figure out that, hey, this is not what I was presented. And then I'll hear agents say, oh, well, that's traditional UL. IUL is so different. No, actually, it's not. The only difference is the interest crediting strategy. That is literally it. It's still built. It's indexed universal life, guys. What's up, my fellow wealth creator? Thank you so much for checking out this clip from the Millennial Wealth Creator Podcast. If you'd like to watch the full podcast, there will be a link down below in the description. Make sure to also check out the additional tools, training, resources that I have in the description as well, just to help you along your journey. Thanks again for checking out the clip, and we'll see you in the next one.